For those of you who have sat through my webinars before, there are probably one or two. On occasion, people come back. Today's topic is a pretty wide-ranging one. It's not the technical analysis I've been doing for the past couple of webinars. We're going to start those up with a full schedule again in the fall. We are in summer here, as I'm sure you are if you're in the Northern Hemisphere. In August, when everyone tends to go on vacation, I myself am going on vacation starting on Monday. The topic today is most related to Americans, at least what's happening with the American economy, what's likely to happen with the American economy. But that's hardly the gist of it. It's hardly the totality, because what happens in the U.S. economy, it being the largest economy in the world, and the economy of the central bank that largely sets monetary policy for the world. And if the U.S. monetary policy changes, the repercussions are profound across the world. The question for us and for almost everyone else is, I think it's threefold. Let's put it that way. First, and we're looking here at U.S. GDP, which is an innocuous chart. But the first question we have to look at is, let's put it this way. You can look at the U.S. economy and its performance over the past, any period you'd like, but we're focusing, of course, on the period since the Great Recession and financial collapse of 2008. That's one comparison. How has the U.S. economy performed under those circumstances since that great collapse of GDP in 2008 and 2009? In that comparison, of course, especially on a chart like this, which is a year-over-year comparison, you're going to look better. Meaning that, yes, the U.S. economy is no longer collapsing at a 5% rate, and it has assumed a reasonable growth rate. Not only that, you can compare that to some of its economic competitors around the world, the EMU, Germany, China, and it looks reasonably good. The recovery is real. In other words, we're not still in a depression. That's one comparison. The second comparison is historically for the United States. How has this recession and this recovery compared to the historical performance of the United States in the past? And the third comparison is to, as I mentioned earlier, its economic competitors around the world. So you have three ways to compare to, are we doing better than we were during the recession? Of course. That's largely a political comment, meaning that, yes, of course we are. Unless we're still declining, how could we be worse? But nevertheless, that is a reasonable comparison because it is real to people involved in the economy, you and me and everyone else. Historically, that's a much more fraught, a much more difficult comparison, because what happens is as soon as you start making the comparison, it ends up being a partisan discussion as to why that may or may not be the case. And I'm not at all interested in partisan discussions or in why. But I am interested in what and whether or not this gives us anything to go on for, one, the sustainability of the fragility, if you will, of the recovery, and whether or not we can expect a resumption of historical levels. And the last comparison to the world, it is important in the sense that, well, one, it's important because the rest of the world goes in the dumps. The U.S. is going to end up there eventually anyway. Even though the U.S. percentage of its economy that is grounded in world trade is smaller than almost any other developed economy, because the U.S. market, internal market, is so large in comparison. Nevertheless, one of the things, of course, that drives, there are two things. You look at the U.S. economy, it would be driven by two components, or at least what is composed of the GDP productivity, not productivity, but GDP in the United States. One is manufacturing, which is the area of the economy most affected by overseas economic health. But that's only, I don't know, maybe 15% of the economy. Specific manufacturing. And then there are the basic part of the U.S. economy is consumption, which is 70%, 65, 70%, something like that. I wonder if that figure's actually changed. You keep hearing the same figure over and over again. With the further decline of manufacturing, I would assume that figure is probably even higher, although I have not looked at it lately. So say that's 70 or 75%. And that is the area which is not largely affected by economic performance overseas, but it is affected very much by attitudes, by perceptions, by whether a consumer wants to spend. And that is something which can easily be affected by developments overseas and internal. Once again, I just want to encourage anyone who is listening, if you would like to comment or offer a question or make anything, participate in any way, please just type it into the chat box and I will respond to it. I prefer to conduct these as a colloquium rather than a lecture, and so I welcome participation. For anyone who's on vacation and still listening, what are you doing? You should be out enjoying the beach or something like that. So let's move on. So there we have, let's look at the first comparison from the outside. Okay. So the U.S. economy, as the briefest one that I'm going to deal with is the one compared to overseas. So let's just look at that first. Okay. That was the U.S. GDP, and you can see where it is. I put them all here on a year-to-year basis. Okay, because the U.S. Is the only one in the world that I know of that compares its, sort of like the U.S. chasing its citizens overseas for money they earn overseas, no matter how many years they live overseas. Having been an expat for many years of my career, I have always thought that was a rather greedy peculiarity on the United States part, but it is true. Anyway, I just happened to read an article on that before it started this morning. Okay, so this U.S. The U.S. does its general, and it's most often quoted in the United States, comparison of GDP as annualized quarterly. Nobody else does it that way. So what I have here are the year-over-year comparisons in the United States. Okay, now if you look at the annualized quarterlies, what you're going to see is that for 2014 so far, the U.S. economy is growing at a 0.9%, actually 0.95. 0.21 negative in the first quarter and 4% in the second quarter, which could be revised either way. But if you look at it year over year, which is what I'm doing so I can compare with other economies, 2.4%. Let's just, since all these comparisons are more or less along the same statistical basis, we can just use them for comparison without discussing whether or not how they arrive at that particular item. So 2.4%. Okay. Reasonable, considerably less than prior, but we're not dealing with the prior here. So hold on. Okay, so that's the U.S. We all know what we're going to find here, I think. GDP in the EMU, not good, and 0.9%. So as far as the recovery in the United States goes, 3 times as good, almost 3 times as good as in the second largest economic bloc in the world. Economic bloc, not country, which is the EMU. Now, there are great disparities within the EMU, which is part of their problem, but we're not going to discuss those. So the EMU as a whole, very unimpressive. So let's look at the GDP of Germany, very much like the United States. Two very differently structured economies. Germany being the world's premier export powerhouse. I think I've used this figure before, but up until last year, the dollar value of German exports were the highest in the world. That is for a nation of about 80 million people, I think. They were overtaken. I've told you this before. I know that we were overtaken by dollar value by China, who has a population more than 10 times as great at 1.2 billion people. So Germany's luxury product and industrial goods. I don't mean that the industrial goods are luxury, but the quality of their products make them a very unusual item in the world economy. They also seem to make the case that there's really only enough consumption for one, around the world, for one country to run its economy like this. Because if you do the comparison between the German economy over the past 15 years and the Japanese economy, another exporter of high quality goods, very export dependent in its economy, and the United States. The United States is also an exporter of very huge amounts of high quality goods. It's just that in comparison to the size of the economy, they don't make nearly as profound impact. And you have an odd situation here. And I don't quite know how to make of it, but I will mention it. The Japanese economy and its exports are a similar item to the German. Yet, meaning their place in the world economy, their place in consumers' hearts, if you will, or consumers' garages or whatever they are, or machine tools or industrial products. Japan moved, as China's attempting to move, from a very low-level consumer goods-oriented export model back in the early 60s, based largely on low wage costs, to a much more high-end, higher profitability, higher demand, at least as far as flexibility goes, product now. So Germany has always had that type of product. That's something to do with, well, let's not speculate on. But Japan has made that move. China's attempting to make that move, although I would say not really as effectively as Japan has. So you're looking at the curious item that Japan's performance seems to have less over the past 20 years, seems to have less, because they established in the 80s a very strong position in the world export market. And it sort of frittered away. It sort of disappeared. Nobody knows quite why or what happened. It's not because their products changed very much, but it does seem that their products did not keep up. And the only thing I can lay that to, of course, is the lack of innovation, if you will, in products out of Japan, relatively speaking, to the lack of the quality and the continued development of products in Germany. So Japan has lost some of its export prowess, and Germany has not. Japan's population is declining. Germany soon will. That's the only sort of factor that I can tie that to. Plus, Germany never experienced the type of bubble economy that the Japanese permitted to develop, nor did Germany attempt to alleviate it or alleviate its economic problems when it had them by printing money. which the Japanese have assuredly done, or at least as far as flooding their economy with liquidity. They've been doing it for 20 years. It clearly hasn't worked. They did not really reform labor practices or any of the other things that would permit companies to innovate. Germany did, and it was painful, but they did it in the late 90s, and it's had a tremendous effect. Okay, so we have Germany here as far as they're a reasonable performance. Let's take a look at where's GDP. Let's finish with the EMU. Okay, so I put up the other example, which is a sad and dismal example, if you will. Italy. Italy, another country whose domestic economic practices are much like, not like in actuality, but like in effect as they are in Japan. Inflexible labor markets, and many, many layers of bureaucratic approval. You know, I've always said, you want the two serious things for an American, for a consumer anywhere: clothes and cars. Well, if you want the best, you got to go to Italy. That's of course not true, and many people will argue German or American cars or Japanese cars. You always make all these arguments. But the Italian sense of design and innovation has been very resilient, but the economy has ceased to perform. Just in the last reading, and one of the things which is certainly dragging down the euro, the Italian economy is back in recession by the standard definition of two subsequent quarters of negative GDP. This is their third recession since 2009. There is, again, something happening with the Italian economy over the past really 10 years. It's been a long time now, but certainly now. And again, the speculation, we'll put it this way. I've always made great stress on Japan's declining population, but Italy and Germany are not far behind as far as where their populations are. Nobody's having children, like all the developed world. And without children, you don't get innovation. But, this is a relatively new phenomenon, at least as far as actual declining population goes. So it does, and Germany is there as well. So it doesn't seem that that's the sole issue. It is true that neither Japan nor Italy have successfully reformed many of the internal practices, domestic practices, which would help free up labor, innovation in their economy. Okay, so we can see that the EU is very much, or the EMU, very much a split party. Okay, let's take a look at Japan. A reasonable performance, but if you look, you can see that in 2011 and again in 2013, I believe, end of 2012, 2013, the economy again dipped into recession. Compare that to the U.S., which is right here. No extra recession after that. Recession line is down here. And look where it is for Japan. It's right here. So both Japan and Italy have some serious problems with their economies. And what's going on here is they've basically been in recession for 1, 2, 3 years now. There are a couple of periods in here where there is remember, this is the year-over-year quarterly. If you look at the quarterly figures, there are a couple of quarters in here of various places where they do have positive economic growth. But Italy's basically been in recession for now 2.5 years. These are not comfortable figures. Take again a look at the EU GDP. Again, the EU, again, in here, this period here, the EU has basically been in recession, was in recession for 2 years. 2012, and 2013. We can look at the last one I'm going to look at, of course, is China. China, anomaly amongst anomalies. Interesting thing you want to note about the Chinese graph, zero's not even, doesn't even make the graph by several factors. Even in 2008 and 2009, according to their figures, growth dipped to just over 6%. Now, of course, the Chinese supported that by enormous amounts of spending, which they are dealing with now. Nonetheless, so do the rest of us. And it really didn't do, it kept it humming along. So we have there. The one last one I want to look at as far as comparison goes is Canada. And this, you could look at Australia. Australia looks like this as well. But this is probably, in my opinion, the best managed economy in the developed world. And it looks, the lowest you get is a dip down here at the end of 2012, and then it rises back up. Low unemployment, not only an export resource provider, but of course it is. But, I mean, for China, I mean, for Canada, Canada's tied closely to the United States. The U.S. has had a very bumpy recovery, although better than most. So, on that particular way of looking at the U.S. economy, the comparisons are more than reasonable as to how it's performing in relation to the rest of the world. But now, we have to look at the U.S. The easiest thing to look at, we'll look at them both at the same time because they're really related and they certainly relate to the same charts, is how the U.S. compares historically, both historically as far as going back into 30, 40 years as far as U.S. performance, and how it has compared to the performance after the recession. So we'll look again here at GDP. Okay, one last time. So when we look at that way, and I'm sorry, I should have put in a longer GDP chart. But I think we've all heard these figures, and I can talk about them easily enough without having to show you the chart. The recovery of this particular recession, although it compares reasonably well with the recovery from the 2001 recession and the recession, after the dot-com bubble in the late 2000, late part of the last decade, the prior decade, and 2000, it does not at all compare well with the prior historical recoveries. Now, again, without looking as to why, demographics, economic policy, interest rate policy, without looking at why this particular recovery has been half. I don't know exactly what the figure is. A number of prior recoveries, certainly a very powerful one in the 1980s. The fact remains that it is. And we cannot ignore that fact by addressing it through reasons, by saying, well, it's because of this and because of this and because of this. The fact does remain inescapable that a weaker recovery creates less wealth. A weaker recovery is less growth. And all of the attendant goods, as in societal goods, that are part of a strong recovery, their reverse is also true. They are lacking in a weak recovery. And that is, without a doubt, a fact of the current economic situation. Wages haven't increased. Employment has barely increased. But let's look at some of those. I know, barely. Everybody is now getting excited. What do you mean barely? Hold on. Let's take a look. In a consumer society, It is, guess what? The consumer who rules. Consumers need jobs in order to spend, and they need income. The two are not necessarily, the two are the same, but a rise in one doesn't necessarily mean a rise in the other. Let's put it this way. Let's take a look at unemployment on the 30 years. Okay, this is the unemployment rate over 30 years. Now remember, this is the one that comes from the household survey. Very rapid fall in unemployment. You've all heard this, but I'm going to say it again. Most of the decline in unemployment here is not the type of decline that produces spending in the economy. What do I mean? The reason this unemployment has fallen, has fallen is because of this. Labor force participation rate. If the U.S. labor force participation rate, by the way, a little sociological fact here, the reason it was rising from the 60s through the early 90s was basically because women were joining the workforce. I've worked in New York finance for 25 years. My wife has worked in New York finance, for 20 years. And the evolution of women in the workplace, especially in finance in Manhattan. I mean, I live in Manhattan, and the biggest industry, maybe the only industry sometimes, in New York is finance. One of my nieces just joined the financial world, and I sent her a text saying, "Welcome to the real New York City." I'm a bit parochial in that sense. But the change in the environment for women, and just the prevalence, has been astonishing. I remember when Liz and I knew each other 20 years ago, there were very few women in trading. There still are. Trading seems to be a particularly male environment. But just in finance, managing directors with female managing directors were extremely rare. And Liz, my wife, was one. But the interesting comparison, of course, is to my niece, for whom this is not true. She's just joined a big financial firm in New York, just moved to the city, just graduated, and that's not true. There are many women, and the attitudes towards women have evolved, shall we say, and it's a positive evolution, without a doubt. Anyway, so sorry about that little side there. So the rise in labor force participation up until probably about 1990 was largely driven by women joining the workforce. And from 1990 until what date do we have here? 2009, or you can say 2008, it varied 1%, between 66 and 67%, with the peak in the late Clinton years and the early George Bush years, if you want to put them in political terms. And almost all of the decline in the unemployment rate from here to here is because this has declined as well. Now, you may not think that 66 to 62.9%, which is actually 1%, 0.1% above the modern generational historical low, which was 62.8%, is a big deal. But across an economy with 150 million workers, it's a huge amount. It's a huge amount of foregone income, of energy, of productivity. This is the reason the unemployment rate has fallen. If it was what it was at the beginning of the recession, the unemployment rate would be somewhere between 9 and 10%. Think about that. This is one of the reasons, and maybe the main reason, that the U.S. economy has not been able to gain its cliched escape velocity. Because, and the Keynesians, including Mr. Bernanke and many others, have always spoken about the output gap, meaning that the economy is capable of producing much more goods than it is producing. But why are producers not producing? Well, they're producing at a lower level because consumption is lower. And one of the reasons, maybe the main reason consumption is lower, is because the jobs have not been replaced. And the unemployment rate, as depicted at 6.2%, is a totally phony statistic when you're looking at the consumption side of the equation. Because all of that purchasing power, which has been lost and not replaced, is why there's an output gap. That's why the Fed has been constantly trying to goose the economy. Okay. I did say phony. And yes, I've often felt, and still do, that the unemployment rate as depicted with their definition of having looked for a job in the past month is a phony rate. It does not speak to the economic effects of unemployment. It hides it, basically. Okay, let's take another look here. So remember, we need jobs, and here's non-farm payroll. Okay, now this is a 20-year non-farm payroll. So remember, consumers need two things. They need jobs, but they also need income. These are jobs. When you look at the performance of the U.S. economy over the years since the recession, it's fairly true, not completely true, but fairly true. Can something be fairly true? No, it's either true or not true. Okay, sorry. It's fairly accurate to say that its performance has not been terrible. The problem is not the number of jobs created in this period here, although they're not great. And if you go back further, they look much worse. But they're not terrible, okay? I mean, the zero line is here. So the economy's been creating jobs since 2010 on an upward trend, an upward slope to the line. The problem is that the loss in jobs, was so incredibly steep, widespread, and large, that in order to replace, as I said, the consumption, those jobs have to be replaced. Those people have to find income. They have to be able to spend. They have to feel able to spend. And the economy has not done remotely enough to replace those jobs. So there is a permanent lowering of the consumptive ability of the economy. And that leads, of course, no doubt, I agree with your comment. The U.S. is absolutely recovering slowly. And that was part of my point in comparing it to the rest of the world. In a world such as ours, the solitary analysis in my mind is pointless. It's true historically, it's true economically. Things need to be put in context before we make any judgments about the quality here. But if we're looking at the reasons for it, this is probably in my mind, this is probably the main reason. It isn't so much that the economy has not succeeded in creating jobs, it has, but at not nearly enough rate to replace the income lost here. Okay, let's take a look at another. So that's the problem on one side. Let's take a look. Remember, we need jobs and income. And this is where it gets a little tricky. Okay, let's take a look at manufacturing payroll. Again, same thing with manufacturing payroll, as you saw with non-farm payrolls. Not a bad performance as far as jobs. In fact, if you look at it, the trend, if you go back another 30 years, another 20 years, the trend is down. That has to do with, of course, outsourcing jobs overseas and stuff like that. Just to comment on that, you have many political figures, public figures, shall we say, who give tons and tons of lip service to both on the business side and all sides, to the need to support middle-class income, middle-class lifestyles, middle-class jobs, all this other nonsense. It would be relatively easy to create a policy that would enhance U.S. manufacturing. And I'm going to hear lots of screaming outside. It's not true. It's not true. It is true. No doubt about that. No doubt about that. I've read many articles about machinery being responsible for this, automation, machinery, and efficiencies. There are many jobs nowadays, of course, where it can be done more efficiently by machines. However, you can also look at economies such as I read an article recently that laid the Swiss unemployment rate, which I think is 3.2%, and hasn't been above 4% for God knows how many years, to the fact that they don't have any minimum wage there. It seems a bit simplistic, but it probably has some effect. The U.S. has, from a manufacturing point of view, huge advantages. And it has a newly added enormous advantage, which is an incredibly low cost of energy if you're looking at natural gas. When businesses set up, one of their chief cost is always the employees, always. But one of the next most expensive costs is for energy to run the place. And the U.S. has a huge advantage here. It would be, if not easy, it certainly would be possible to provide advantages to U.S. manufacturers, perhaps not to move plants and machinery and goods producing things back from overseas, but certainly because of the enormous sunk costs involved in moving a factory to China or Indonesia, where we move it to, Jordan, where we move it to. But to certainly make a real attempt for new facilities to be established here. After all, it's a lot easier for a U.S. company to open up a plant here than it is overseas. Unless they're servicing an overseas market, that's different. And that is the type of attention from basically government that would assist very much in manufacturing and other plants here. Okay, so let's move on. So again, as with the overall non-farm payrolls, the problem here is not so much the performance afterwards, but the performance after the recession is inadequate to replace what happened in the recession. Therefore, you have a permanent, or at least a long-term, reduction in consumptive ability. Let's look again here. And this is where the problem becomes more complicated. These are average hourly earnings. The reason I don't have this, I do have a longer-term chart. This particular statistic series doesn't go back far enough. But as you can see, the increase in average hourly earnings, there isn't any, basically. What's inflation? 2%. What's the increase in hourly earnings? 2%. That means not only have we not replaced the jobs from the recession, but nobody's making any more money. Now, from a business point of view, it's perfectly understandable. Lots of competition for posts, high unemployment. Remember, unemployment is not 6.1%. It's more like 7 or 8 or 9%, depending on how you want to categorize the people who have stopped looking. But it's much higher than 6.1%, 6.2%. So again, the people who are working. And in a way, this statistic is more meaningful for the economy because the number of jobs created is spread across several million if we had replaced all of the jobs. And that would be a large chunk of the economy. But there are still 150 million people working. So 2 million new jobs will create a certain amount of, will put into the economy a certain amount of new income. But a tiny increase for the overall pay of 150 million people produces a much larger benefit to the economy, a much larger potential consumptive, sound like I'm talking about tuberculosis in the 19th century, where it was consumption, a much larger addition to U.S. GDP or U.S. potential GDP. So this statistic, in a way, in this particular way, is much more damaging to the economy than the prior one. And combined, there's nothing good happening here, or not nearly as much good. Let's look at another one. Average hourly, average hours. Again, what you're seeing, excuse me, when you talk for 45 minutes at a clip, your voice tends to get a little dry. I apologize for that. Again, there's been no increase in hours. So it isn't even only that jobs are not being created, but after the firing, the largest part of the increase in productivity after the recession has been the firing everybody and everyone forced to do more work. But no one is being asked to do more work because there is more sales. Okay, let's look at this. This is how I just take a look briefly. Household unemployment. You know what? You can't tell too much from that chart. This is a very, very volatile chart, but this is what actually produces the unemployment rate. Okay, so now let us look at income. Okay, this is personal income. This one I'm using because it's a historical chart. You can get I got a generation out here. Now remember what we're thinking about. We're thinking about the performance of the U.S. economy. Is it one sustainable? Is it historically accurate? And do we think it's going to get better? And the biggest part of that is consumption, consumers, you and me. And the biggest part of that, the biggest dictate of that is income. Whether it's income because you have a job or don't have a job, or income because the wage rate, your compensation, is increasing. This is what we are seeing here. Okay, now, U.S. personal income year to year. A lot of this huge rise here, of course, is simply because it's falling here. It's trouble with year-over-year comparisons, but we can't get away from them because they're the most common. So, how does this compare? And here you can see the problem. The average compensation increase has been steadily declining. And the performance of income after the recession has probably been the worst of all prior business cycles. Again, without talking about the reasons, and some of the reasons is always, a deep economic discussion, and one which inevitably ends up with, shouting in print about who's right and who's wrong. But there's no escaping the fact that the performance, the fact, not the reason, of the U.S. economy over the past 6 or 7 years, or really say 5 years, has been dismal. Take a look at another look at this. Okay, that's personal income. Personal income and CPI. Look at the gap here. We're talking maybe 2%, maybe 1.5%, and we're talking over here at 7%. That's a 5% gap here as well. Again, huge gaps here, here. Wow, that's not good. over here. And again, over here, the overall and sustained increase over inflation is much, much narrower. And that is a large part of the problem with the U.S. economy. Take another one, disposable income. Remember, this is personal income is here. This is CPI. Now, a brief comment on CPI. You probably heard this from me. I do not go. I know the Fed may determine its policy on its core CPI rate, but I personally think the core minus food and energy is nonsense. It's a self-serving adjunct to bureaucratic policy and the Fed. If anyone can live by only consuming what's included in the core CPI, please let me know, and let me know how you do it, which is why I do not use that analysis for my comparisons when you're talking about how much income is actually out there in the economy and how much you can spend. As far as I can tell, gasoline has been above $3 a gallon around New York for years, above $2.50 for years. So the idea of excluding that makes no sense to me. Same with food. So this is a comparison of CPI. Now, the ECB agrees with me, or at least I agree with them, which I think is probably more appropriate, in that they include, they look at headline CPI. And that is what I think the Fed should do as well. The Fed's performance as far as inflation goes wouldn't look nearly as good if they did that. But that is that's the identical to the use of the unemployment rate by excluding anyone who hasn't looked for a job in the previous month. Nonsense. Self-serving nonsense for the bureaucrats. Okay, so here we go. Disposable income. If there is any particular graph, display, statistic, which encapsulates the problem that the U.S. economy has had, it's this one. Disposable income. This is corrected for inflation because it's chained. Anytime you see a chained statistic, it means it's corrected for inflation. I hope that's true. It is true. The trend line is a line that I drew. I mean, it's not a statistically derived line. I just drew it to give a sense of the direction of the chart. The purple line is the yearly moving average. And this is where you can see what the problem is. Without income, disposable income, this takes into account taxes. This takes it into, and there isn't enough leeway here to produce the type of recovery that is necessary. Okay. This is a depressing chart, as far as I'm concerned, as an American. Okay. Do we see that? Now, this is a chart which I want to show you because it doesn't make a lot of sense. This is weekly jobless claims, which in the old world, meaning pre-2008, was a very reliable indicator for new jobs. And in fact, it remains a reliable indicator of new jobs. Somewhere around here, somewhere below 350 is where we dipped into, say, back in the middle of 2013. Okay, let's just say that was the historical level where job creation starts to accelerate. So, okay, middle of 2013. Let's look at, where's my non-farm payroll? Middle of 2013. Okay, so right about here. Remember, zero's down here. So certainly from that time about here, except for this one dip here, that's one down to 29, I guess. It has been an accurate predictor of what's going on with the U.S. labor economy. Okay. Now let's look at some of the consumption ideas. We spoke about income as to whether as jobs and what the problem with job creation is. It's not the fact, it's the amount. We have not replaced remotely the jobs lost during the recession. We talked about income. Jobs and income produce consumption. And because of the unemployment, because firms don't have to increase wages, there hasn't been any other way around, rather than right to left. You're seeing the same type of issue here. This mirrors exactly what you'd expect. The change, the slope in income. How could it not? Are we all irrational? Do we all live and spend and, pretend we're Louis the 14th or what was that? Louis the 15th? Après moi le déluge? I don't think so. That means after me. It's a very common cliche. I do not speak French. After me, the collapse basically is what it meant. Because the French monarchy in those days spent and spent and spent and spent and didn't have any money. And what brought the revolution more than anything else, the collapse of French finances. I'm not going to make any argument with that, but that's certainly one of the things. So we have here the same problem. This is a mirror and the image of the problem with the U.S. economy. Real final sales. Real final sales is consumption without inventory. GDP. Is it GDP? No, it's consumption without inventory. That means when it's the goods that are actually sold, not just produced. So here we go. Again, looking at the same slope, unfortunately left to right. This is retail sales control group. Okay, remember retail sales, which gets quoted all the time, is a non-price corrected statistic. This is retail sales. It's called the control group. It's the retail sales figure that's closest to what goes into GDP. This is I have the inflation on here, the CPI. Okay, remember what I said about CPI. So again, the problem we're seeing is this gap between sales and inflation, sales and inflation, sales and inflation. Look at the sustained gap here. Even here, although less so. And look how much less it is here and through here. The U.S. economy is not producing, again, the type of income to permit people to look optimistically at the future. Now, we have to wrap up because we're almost done. Let me just see if I can choose a chart here that will give you a sense. Well, I think I already used them all. So let me just bring up this one right here. Sorry about that. Let's use that one. Okay, that is personal spending, and I'm using it because of its historical breadth here. So the question that we're addressing is this particular U.S. I think I used in my write-up that was on Epoch Street the word autarky. Autarky is kind of a odd word. It means an economy that is largely self-involved. Doesn't participate in the rest of the world. It's, of course, not a reality in the modern world, and it never really is a reality. You have an autarkic economy in the U.S., you have in the modern world, you have an incredibly poor one. But in the sense that the U.S. economy, in order to sustain and grow, to grow at the cliche rate of all the economic commentators out there. It will have to do so in a largely, not completely, autarkic sense. First of all, the U.S. economy is not export-driven. So even if the rest of the world was booming, which it's not, it would have less effect on the United States than, say, an economy like Germany or Japan or China. And anyway, that's not the case. The Europeans are moribund, to say the least, aside from the Germans and one or two others, the Finns maybe. The Chinese are goosing their economy relentlessly with deficit spending. They have not changed that, even though they said they were going to. And Japan is suffering from, it seems to be, permanent population malaise, to put it anyway. So if the U.S. is going to continue and to power this economy, then it will need to largely reference itself. Spending is going to have to come from here. And this is what I get back to with this particular chart as emblematic of what we're doing. Now, it's always easier to be pessimistic because when you are in a particular, it's like you're in any particular mindset, you simply project it out into the future and you end up with your projection and with your forecast. And so it's always easier when the economy is growing slowly to think about why it's going to continue to grow slowly or maybe even shrink a little bit more. And I'm not trying to do that. I'm trying to avoid that. But in order for U.S. producers, the U.S. economy, to grow at a faster pace, businesses and consumers have to be able to look to the future and say, I'm going to spend, I'm going to create, I'm going to hire, I'm going to bank on an improvement. Part of this is psychological, and part of it is factual. And until we can reverse this chart and the income charts that mimic it, it's difficult to see where this increase is going to come from. And this has been my problem, and I think this has been one of the great issues with economic commentary over the past 5 or 6 years. The broadest criteria are the ones that are most routinely ignored in commentary. And so this chart is emblematic of them. Okay. I thank you all very much for attending. I know we've been running for about an hour here. I hope this was interesting. I hope it was useful. I often hope that it's humorous, but it rarely is. If you have any comments or any criticisms or anything else to attend on my presentation, I will put my email address in there. Please send me an email and I'll be glad to respond. And once again, I thank you all for coming and I thank you for taking the time to listen to me. Take care, everyone.